have the honor now of introducing our special guest, Timothy Halleron. Tim is a fellow of the American College of Trust and Estates Council, and he's a frequent writer on a variety of tax and estate planning subjects. He's also been recognized for the last 2 years as one of the best lawyers in America for trusts and estates. And Tim has a terrific presentation, which I've had the pleasure to see already. And I wanted to mention, since many on this call today are volunteers, that Tim is an active volunteer himself in this area of expertise and volunteers for plan giving matters with the Ravinia Festival and the Shed Aquarium. So thank you, Tim, for your service there, and thank you for joining us today. So take it away, please.
Thanks, Mary Ellen, and thanks, Ovid, for the great presentation on everything that Solve M.E is doing. So here, I'll share my screen. So as Mary Ellen said, I'm going to talk a little bit about trends in plan giving and philanthropy. And feel free, Mary Ellen, Ovid, if you have questions, please feel free to interject as I'm going along. I guess thinking about the three things a lot of our clients are focused on as they're looking at the landscape these days in terms of charitable giving and philanthropy. The first thing is to always make sure that your estate plan is in order. So I'll get into this a little bit. The second thing is to work closely with your advisors, meaning your accountants, your financial advisor, your attorney, just to make sure you know what the current landscape is in terms of tax legislation. It is ever changing in what we do. And this year we are anticipating additional changes that are going to occur because the Biden administration is looking at a huge infrastructure bill and is looking at ways to pay for it. And so we anticipate that we will see tax rate increases on the individual income tax rate and the capital gains rate. We may see changes in the estate tax legislation. We may see changes in the gift tax legislation. So while a lot of what we do is constant from year to year, but the tax law changes really do trigger certain events in our clients' lives that they may not anticipate, but keeping in touch with your advisors can definitely help stay in front of these things. And then lastly, I'll talk about getting involved during your lifetime. So we talk a lot about how charities and individuals are the beneficiaries of your estate. So at your death, your estate may pass to certain family members, individuals, charitable organizations, but there are opportunities to give during your lifetime that can be meaningful and impactful for a number of reasons. So we'll talk a little bit about that too. So leading off with getting more familiar with your estate plan and updating your estate plan. So I think of, whenever I talk to new clients or clients who haven't thought about their estate plan in a long time, I think of kind of the estate planning 101 package, which includes your will, a revocable trust, powers of attorney for property and healthcare, and then also your beneficiary designations. So what are these things and why are they important to our clients? Well, your will and your revocable trust really provide for the disposition of your estate in an efficient manner. Your will names your executor or personal representative. And the way our clients' estate plans are set up, it will typically take any assets that are held in your individual name at your death and pour them into your revocable trust. So that's the other piece of your estate plan. You may decide to fund your revocable trust during your lifetime. It's also called a living trust. And the reason you would do that is, to the extent you actually put assets in your revocable trust during your lifetime, you avoid probate with respect to those assets. And so you're kind of skipping an administrative step that would take place at your death, being the probate process. And so that doesn't necessarily make things easier for you, but it does make things easier for the people who are actually going to be administering your estate. So your executor or your successor trustee. It saves them the hassle of going through probate with your estate assets. The other benefit of having a revocable trust is that it does provide a level of privacy to your affairs. So your will is generally, it's filed with the local probate court, and it's made part of the public record. So you can go into most probate courts, at least pre-COVID, you could walk into a surrogate's court or a probate court, and you can look at different people's wills. They're not private, it's all public record. Your revocable trust does not become part of the public record generally. And so to the extent you have individual dispositions or charitable interests, and you don't necessarily want people knowing what they are or knowing what the dollar amounts are that you're leaving to certain people, you can include those in a revocable trust, and they generally remain private. Powers of attorney for property and your healthcare proxy and living will, these are really important during your lifetime. If anything ever happens to you where you can't make decisions for yourself, having an updated power of attorney for property means that someone will have the ability to take care of your financial assets, your real estate, kind of handle your property when you are incapacitated. Every state has a different form of power of attorney. And so it's again, keeping in touch with your advisors and making sure your documents are up to date is an important thing. Same is true of the healthcare proxy and living will. A lot of changes have been made to healthcare proxies over the years with HIPAA, and then states looking at these things differently, changing their forms to really try to make them more user-friendly. And so again, I think it's a great idea every few years to look at your estate plan, including these powers of attorney and healthcare proxies, just to make sure the people you're naming as your agents and beneficiaries are still the right people and the right organizations. And then beneficiary designations, these are things that come up in life insurance policies and retirement plans. And I do find that our clients, they tend to forget sometimes that they have these things. So, you meet with a new client and they'll say, oh, I think I have there are 5 or 6 retirement plans because I've had a number of different jobs during my lifetime, and I've kind of never rolled these things together. I might have one at Schwab, one at Vanguard. I'm not sure exactly, and so at the end of the day, it's a good thing to kind of go through your files again, make sure you know where all your retirement plans are, but then take a look at the retirement plan beneficiary designation. It may be that it's fine. You may name your spouse in the event of your death and then name your children, but you might also think about, and I'll get into this a little bit later, if you are charitably inclined, those retirement plans can really be a great asset for charitable giving. And so what I come across a fair amount of is young people who don't have an estate plan put together because they feel like they haven't made all of the decisions they have to make to get their estate plan together. And one of those decisions can be, who should my guardians be? So who should act as guardian of my minor children? And my response is just put something down on paper. You gotta get something down on paper that makes sense, knowing what you know now. You can always change these things in the future, but don't wait to put something down on paper that gets you 99% of the way there. Again, this basic estate plan is totally amendable, revocable. You can change it when you want, but getting something that works down on paper is not only going to put your mind at ease, but also put the people who are going to have to take care of your estate in a much better position to do so. And then it also gives you a chance to reflect on the individuals and charities that you really care about. So a great thing to kind of get together in your head what you want to do with your estate. So as Oved was saying, with COVID-19, a lot of changes have occurred in our lives, one of them being tax incentives. So in 2020, legislation was passed to increase your ability to give to charity, at least your ability to deduct those charitable contributions. And those incentives have been extended for 2021. And so now we're well into 2021. These rules have been extended. One of the main benefits is being able to deduct up to 100% of your adjusted gross income. And that's up from 60% pre-COVID or pre-2020. So that means you can literally offset every dollar of taxable income with cash contributions made to qualified public charities or qualifying public charities. And if you make excess contributions, those deductions can be carried forward for up to 5 years. So there's a lot of room to make charitable contributions now and get tax relief for those charitable contributions. One note, this increased AGI limitation is not applicable for gifts to a donor advised fund. So a lot of our clients use donor advised funds. They find them very easy to use, very user friendly. It's almost like setting up a bank account. And then they can use those donor advised funds to make charitable contributions from year to year. This increased charitable or increased AGI limitation does not apply to those donor advised funds, but it does apply to gifts to public charities like Solve M.E, other operating charitable organizations. And then those rules apply for taxpayers who itemize their deductions, but even for non-itemizers, there are some tax incentives that are relevant. So donors get an above the line deduction for up to $300 without itemizing. And then if you're a joint filer, married filing jointly, you get an above the line deduction for up to $600 in cash contributions to charities. And so we'll see if that's extended again for 2022, but at least for 2021, that's the rule. And then we can't forget that corporations are people too. So a lot of our clients run businesses, and those businesses to increase their standing in the community and for other reasons make charitable contributions. And those corporate donors can now deduct up to 25% of their taxable income. So there's room to make charitable contributions from your business as well. Retirement plans have been, obviously a great deferral strategy for a lot of our clients. And over the past years, the IRS or Treasury has passed legislation that allows you to use those deferred retirement accounts for charity to an extent. And so if you are over 70 and a half years old, you can make a donation from your IRA assets directly to charity up to $100,000 every year, and you don't have to take that distribution into taxable income. So the $100,000 can go directly to the charity, the public charity of your choice, and you don't even have to take into account that taxable income on your tax return. That rule has been around for a number of years, and it's been extended every year. But this, even for clients who are under age 70 and a half, but over 59 and a half, this 100% AGI rule can get you to the same place. And so this is where this more recent tax incentive can help. And so what you can do if you're over 59, you can take a cash distribution from the IRA. You can contribute that cash directly to charity, and then you can completely offset any income tax with the charity deduction. And so it kind of 70 and a half years old. And this is a result of this 100% AGI rule. So it works as long as Congress says it works. And there's a great strategy if you're between half or I should say, at this point, over 59 and a half, and you're not dependent on existing retirement funds for income. If you're over 70 and a half, again, and not dependent on those funds for income, it's a great way to feed some money to charity. A little bit more on retirement plans. Roth conversions have been popular for a number of years, but when you combine them with this 100% AGI deduction, they become really popular, or really efficient, I should say. So you can now convert a traditional IRA to a Roth IRA, and then you can offset any income tax that you realize on the conversion. Because remember what happens when you convert a traditional IRA to a Roth IRA, you are triggering an income tax. You're paying the income tax now so that that Roth IRA will not be subject to income tax in the future. And so when you trigger that income tax, if you do that currently, you can use that 100% AGI deduction to offset all of the income tax liability that occurs when you trigger that Roth conversion. And so as a result, you're making a charitable contribution, you're getting this Roth IRA that can now grow on a tax-free basis in the future, and charity's getting something out of it too. So I look at a lot of these situations as win-win for the individual and the charity. And so just to distinguish between naming a charity in your estate plan and doing lifetime giving, or to talk a little bit more about the two strategies. So from a transfer tax perspective, and as an estate planning lawyer, the taxes that we are usually concerned about are transfer taxes, meaning gift and estate tax. We're also concerned about income tax for our clients, but let's think for a second about gift and estate tax. So any contribution to a qualified charity qualifies for the gift and estate tax charitable deduction. So you would never pay gift tax to get money to charity. You would never pay estate tax to get money to charity. And so that makes sense, and it's a good incentive for people to give to charities. They shouldn't have to pay gift or estate tax to give to charity. And so what are the options in naming a charity in your estate plan? You can provide for a specific dollar amount. You can provide for a portion of your estate, a percentage or a share of your estate to go to charity. Or a lot of our clients, they make specific bequests to individuals. So they'll leave specific dollar amounts or specific property to certain individuals, and then they'll leave the balance of their estate, whatever it is, to one or more charities. So there are plenty of options to leave money to charity at your death through your estate plan. And you won't trigger any estate tax on that portion of your estate that goes to charity. So it is efficient from an estate tax perspective, but what you may be missing out on, and so thinking about the income tax consequences of your contribution, if that contribution is made at death, there is no income tax benefit to making that contribution. And so the tax incentives that I went through earlier, the income tax incentives, you only get the income tax benefit if you make these transfers during your lifetime. And so I'll distinguish between giving through your estate plan and lifetime giving. And so one of the things that our clients come across a lot is trying to decide between a gift of cash and appreciated securities that have been held for more than a year, so long-term capital gain property. And the answer invariably is give the appreciated securities to charity. And we have had, unfortunately, we've had situations where we have not been asked the question, and then we find out later that what a client did was actually sold securities to raise cash to make a charitable contribution. And it's not the best way to do it. So there's an easier way, and the good news is it's actually more efficient from a tax perspective. So if you give appreciated securities to charity, you get an income tax deduction based on the fair market value of those securities, so the full fair market value, and you avoid paying any capital gains taxes on those securities. Charity receives those securities, so they get the stock, and charities don't pay income tax, so they can immediately sell the stock and not pay any capital gains tax or other income taxes. And then what the donor can do, if they had cash that they were otherwise going to give to charity, they can use that cash to buy new securities. Now they own the securities with a high basis, and they've given the low basis securities to charity. So again, a win-win situation. Retirement plans. So, and now I'll flip back just for a second because we talked a lot about retirement plans earlier, and I want to make sure I mention this. Retirement plans are great assets for charitable giving at death. So when you leave retirement plans to individual beneficiaries, so non-charitable beneficiaries, you may be subjecting those retirement plans to estate tax, depending on the size of your estate. But then also the individual beneficiaries will ultimately pay income tax on those retirement plans if they are deferred plans. Charities do not pay income tax. And so a charitable recipient can receive a retirement plan, even if an individual would have paid income tax on it, the charity won't. And so you can literally leave 100% of the IRA or other retirement plan, any deferred comp plan, to charity. It qualifies for the estate tax charitable deduction, and charity won't pay a nickel of income tax when they liquidate that fund. So if you're ever deciding between, do I leave $100,000 from my bank account to this individual, or do I name them as a beneficiary of my IRA? But I also want to name charity as a beneficiary of my estate plan. Well, the answer is use the retirement plan for charity and use the non-retirement plan assets for individuals. And so what are the non-tax benefits of lifetime giving? Well, one, we see engagement with the charitable organization as a huge benefit that our clients find, during their lives, seeing how their donations are being used and seeing the impact they've made on those charities is just a great, they get a great sense of satisfaction from doing that. And then with the greater understanding that they get about what their donations are being used for, it really gives them a better sense of where their dollars should be directed. And so rather than leaving it purely to the charity to decide what to do, and there are situations where that is advisable, but at the end of the day, kind of this interaction between donors and charity, I think I really do find it's good for both sides. On the donor's side, kind of gives you this lifetime satisfaction in seeing your dollars at work and seeing the benefit that you're creating. It can also help reduce any uncertainty about naming that charity in your estate plan. So we have a lot of clients who name certain charities that they think they want to benefit and name them in their estate plan, which is fine. But sometimes I feel like there is this lingering sense of uncertainty about what those dollars might be used for, and kind of ramping up that giving during your lifetime and backstopping it with a place in the estate plan, I think really can reduce some uncertainty about naming the charity in the estate plan. And then, again, thinking about going kind of the balance between the donor and the charity, lifetime giving really does give you an opportunity to hold the charity to be responsible for maintaining its mission. And so, you see a lot in the news these days about a lot on the foundation side about these huge family foundations that have really drifted in their mission, or at least the family members feel like a foundation may have drifted, or a charity may have drifted in its mission from its stated course or what they anticipated that charity would do. And so getting involved during your lifetime can really help you enable a charity to hold on to its mission, make sure it has the funding to maintain its mission. And then you can really hold the charity responsible for maintaining its mission. And that can be done because if you're giving year after year, the charity at the end of the day, they'll know that your funding may be predicated on the charity actually maintaining what it said it was going to do with those dollars. And so getting involved during your lifetime really can create this good, I think of it as a good two-way street for you and the charity, with satisfaction on both sides. And so that's kind of where I wanted to leave off to make sure we have time for questions and comments.